Welcome everyone to Fibonacci X's weekly digest. My name is Philmani. I'm founder of Fibonacci X, and I'm joined by Vatsal and Achal, who are part of our team. Fibonacci X is a venture platform. We do acceleration, investment, and advisory. These are the three pillars of our business. For last few years, even before there was a formal team in place, we have been tracking early stage, growth stage, and late stage venture capital deals in the India ecosystem. And so we have this data which has accumulated with us for last uh, few years. And there are many trends which we observe on weekly basis. Um, as you know, Fibonacci series in itself is about market cycles. So we like to study market patterns, market cycles. So the original thought of putting together this deal alert, a weekly deal alert, which is sent to about 600 to 1,000 top investors and CEOs in India, was to look for those patterns and also identify value creation opportunities in the early stage investment ecosystem. Right? So today we will be discussing deals from week 9, and we'll be going over few companies uh, which we thought were interesting, few deals which were interesting, and then we will also discuss a bit about their business model and in the space, and also probably the sector or the industry in which they are operating. Right. So, Vatsal, do you want me to share the screen? Let me share the screen. So, how to access this deal alert is to just go to our website, which is xfibonacci.com. And if you click on perspectives, and under perspectives, we have deal alert where we upload the deal alert for every week. So now today we are going to be discussing for week 9. So I just click on this and I could see the PDF file, which is open for everyone to download. So we are discussing about week 9. So let's see which deals both of you think were interesting from last week.
So, in the past week, 18 startup deals happened in India, two of them being from the growth stage, which is Series B to pre IPO stage, and the remaining 16 deals in the early stage, which is before Series B funding. So, let's start with the growth stage startups. And as we previously discussed, two startups raised approximately $75 million. First is Genie Mode. So Genie Mode is a B2B cross-border platform for furniture, home textile, apparel, and accessories. So what it does is it facilitates the creation and discovery of the suppliers and ensures that the entire process from sampling to delivery is streamlined. So Genie Mode raised approximately $50 million from multiples alternate asset management, fundamentum, and many more investors. So a little bit more about Genie Mode. So its revenue in the previous year, which was 2023 to 24, was approximately $11 million, and in the next financial year, which is 2024 to 25, it is expected to cross $16 million. Yes. So as we see, Genie Mode was founded in 2021. And since then, till date, they have partnered with approximately 250 suppliers, 100 plus buyers, and have shipped approximately 3 million products in over 16 countries.
I think India Mart's doing the same. It's true. Or and India Trade, I think. So they are the competitors of Genie Mode, or they are doing something different.
Yeah, so companies like IndiaMart and Trade India were founded in 1996. What they do is somewhat related to what Genie Mode does, but they don't have they have a wide range of products, not just furniture, home textiles, and apparel and accessories. So, IndiaMart is a publicly listed company, and only caters to Indian businesses, whereas Genie Mode is a global platform. So, so in more information about IndiaMart, so they generated a revenue of 170 million in 2023 to 2024, whereas Trade India, which is also a direct competitor to IndiaMart with a wide range of offerings, had a revenue of 17.5 million. Another company which is a potential competitor for Genie Mode is Udan. So Udan was found in 2016, and it also caters to Indian businesses with a focus on FMCG products, and it has generated a revenue of 42 million and mainly focuses on Bharat and Middle India.
Just 1 second about Genie Mode. I think what is interesting to mention is their EBITDA positive business. I think their EBITDA is around 2 million. Their revenue is around 140 million. And they're already present operating in markets like New York, London, Barcelona. So the funding makes sense for them because they can now expand their partnership across different geographies. They already have a kind of, I would say, a financial and a business model which is working for them because they are obviously a bit positive and they are expanding as well. So I think for founders who are thinking about growth funding, this could be an interesting learning as well, right? Because the company is already a bit positive and they are already expanding or have presence in different markets, and now they want to do more in terms of uh, market entry and new partnerships, and that's why growth funding makes sense for them, right? If this was not a bit positive and the financials did not make sense, I think it will be difficult for them to get growth funding, right? Um, so one of the reasons why we will be doing these video webcast for Weekly Digest is to also dissect some of these deals, what we think is working for these startups, what do we think are the challenges, and what are some of the learnings which founders and investors in a community can take away, right? So that's what we'll continue to do. So every deal we'll try to give some flavor. What is the Fibonacci X's house view on that particular deal, on a particular investor or particular trend, right? So now let's go to the next one. Next one is also in the growth stage, I'm assuming.
Yes. So the next one is MOC Cancer Care. So this is a startup which is focused on the healthcare sector. And so MOC, what MOC does is that it has a chain of cancer care centers that simplifies the journey for cancer patients by building an ecosystem which is focusing on affordability for the patients. So they have raised a capital of $18 million from Elevation Capital, and last year, in the financial year 2023 to 2024, they have generated a revenue of $19 million, and have grown approximately 45 to 50% from the previous year with a revenue of $13 million.
Got it. So my only question, obviously, cancer is a huge problem, right? Which we need to address within the whole NCD space. Um, my only question is, what is their center level financial model and business model? Is this a capex heavy model? I would like to know a little bit about that. So, and see, even if even if I look at large published hospitals, let's say we stay in Delhi, most of them are building dedicated cancer wings, right? So, for example, Gangaram or Max, which is close to our office, they have a dedicated block for cancer only now because of the rise in the number of smokers. Um, so, what is the unique thing about this change? And then second is what is their revenue and financial model, right? So that could be interesting to learn about.
So, apart from the hospitals, as you mentioned, who have a separate wing for cancer care and oncology care, What MOC is doing is that it's making daycare daycare chemotherapy sessions available in multiple locations. So right now they have I think 21 uh, cancer care centers, out of which proper chemotherapy, radiology, and other facilities are available in only two clinics. Whereas chemotherapy, which are in small doses, which people can take at a daycare center, is available in all the 21, but 19 of them only provide this. What's different about MOC is that it not only has the pre-treatment, it also has the post-treatment. So, for example, during cancer, many people lose their hair, they have problems alongside their body. So, what MOC is doing is that they are building an ecosystem where they have technology where the patients do not lose their hair. They have they have different physical activities to keep the patients active. So they're not just focusing on the treatment, they're also giving the pre-treatment, which is identifying the cancer symptoms, as well as taking care of the patients post the treatment.
Got it, got it. So you mean screening and post-treatment? So the core treatment is still happening at the center, or is it happening at the hospital?
So the in cancer treatment, there are two types of treatment that happen. One is a long duration treatment, and one is which can happen at the daycare center. So the two of the clinics, which is in Bombay, can handle the long procedures, which is for chemotherapy, and the remaining treatments, which can happen on a daycare center, that is where they are also available in the rest of the 19 centers. There are also new startups coming up, which is building on the aftercare of cancer treatment, like Xenon, Onco, and many more.
Got it, got it. Okay, let's move to the next one. So this was from growth, right? There were two deals on growth or more last week.
Yes,
Okay. Now we move to early stage.
yes. So in the past week, as we mentioned, that there were 16 deals that happened in the early stage startups. So we found out three interesting startups. So the first is Kirana Pro. So Kirana Pro is building an asset light model by partnering up with Kirana stores and creating bright stores in comparison to dark stores, which players like Swiggy, Blinkit, and Zepto are building. What they did was in 2025, they also acquired Zopper, who was also building in a similar space, which was a hyper local grocery delivery app by partnering up with local Kirana stores. And although the amount that they have raised is undisclosed, but they raised it from PV Sindhu, who is the national representative of India for badminton.
So does she have a family office or is she investing as an individual? It'll be interesting to learn.
So I
Not
think she
sure. I
has
think
invested
that's
on an individual basis.
okay. And she, I think it may be like a royalty kind of deal because she may also become like a brand ambassador for them as they expand, right?
Yes.
I'm assuming. I don't know. We'll need to check. Um, what is the difference between bright store and dark store? How do you define that?
So what players like Zepto and Blinkit are doing, so they are either leasing out or they are purchasing a land to build their dark stores where they keep the inventory for all the products that they're selling through their platform. And what Bright stores is that there is an already built infrastructure, which are the Kirana stores. So Kirana Pro is partnering up with these local Kirana stores, so they don't have to take up the cost of the infrastructure. What they're doing is they're building their back end by partnering up with these local Kirana stores, which are almost available in nearby societies.
Got it. So I think I'd see that both these models could coexist. So there is a need for dark store in the sense that they give economies of scale uh, to players who are in quick commerce, but uh, Bright Store could work in the locations where you don't have the space available to build dark stores, or maybe in crowded spaces where which are little bit distant from dark stores, and 10 minutes delivery may not be possible, or it may not be possible to navigate those lanes, narrow lanes, etc., or because of traffic. So I think both these models could coexist, and it could also make sense in places where the order volume is has not reached that inflection point that EBITDA level positivity comes to the dark store, right? So the dark store does not make sense because the volume is not enough, or because the location or the address is not available. So in that case, I think bright stores could be complementary. But what is the guarantee that somebody like Zepto will not think about bright store network as well? They can also build their own bright store network, right? So will be interesting. Like what learnings could someone like Zepto or Blinkit take away from this? In locations where they can't build dark stores, I think they could also go for this, right? Because they have the balance sheet to go for it, and they can raise more if required be. So it'll be interesting to see what is the right to win for these companies which are focusing on bright stores versus a well capitalized model built on dark store, but that player can also diversify by attaching to a network of bright stores. So we'll have to see. I think this play, if one of these companies manages to scale up, there could also be M&A and other kind of deals opening up in future. Let's see.
Right. So the next company that we'll be talking about is Quickly. So Kulmini, I know that you have lived in US for 5 years, if I'm not wrong. So did you ever get a chance to, use the public laundromats there?
Yes, I did go to US for college, so I lived there for several years in different parts of US. But I have used laundromats, public laundromats, and some on-campus laundromats as well. So it's a fairly established model there, um, which works well. I also worked on a deal for a private equity fund which invested into a laundromat chain in Midwest US, maybe about 10 years ago. So I understand the business model as well, right?
So basis on that, in India, there's a startup called Quickly. So Quickly has 71 laundromats pan India and is operating through the franchise model. So Quickly is importing the trend of laundromats from US and is pushing the concept in India. So they don't only operate these public laundromats. What they do is alongside the franchise model, they also partner up with hotels, five-star hotels like Taj, Marriott, and many more, and they set up their laundry equipment there. So recently they raised a funding of $5.8 million from Alchemy Growth Capital and Blue Ashwa Capital, and they are generating a revenue of approximately $7.5 million with a growth of 25% in comparison to the previous year, where they generated $6.5 million.
For me, it will remain confined to 1% of the 1%. Besides the B2B use case for luxury hotels, it makes sense because they need to turn around the laundry requests within 8-10 hours, and they need the dryer as well. Indians culturally have been very comfortable washing clothes and putting them in sunlight, right? Because we have the temperature and the sunlight available. In North America, the sunlight is not available for the winter months. And also in other months, it's not as bright as India. The temperature is not as high as India. So drying clothes is a problem, right? So this having that dryer, that's why the laundromat concept works there in India. At household level, there is still preference for doing laundry inside and then putting clothes into sunlight, right, in our balcony, etc., etc. But I see a strong use case if they can do a good job with large hotel chains, luxury hotels, where people have requests for laundry, which has to be turned around in a certain number of hours. And I think for hotel also, their core expertise in providing the experience. Nobody cares who's running the laundromat at the back end. So if they tie up with players who specialize in laundry, it makes sense. But I think in that case, the margins are going to be thin because B2B hotels themselves are not great paymasters. Plus, the payment cycle, I think sometimes is longer with hotels, right? So even our portfolio companies, consumer-facing brands who are working with hotels, we have realized that the payment cycle and the margins are two challenges. So let's see how it works out. But on the B2C side, I see very limited potential right now. It may pick up in the coming years. Obviously, the money is given for future TAM, not for the current TAM. So it may expand in tier one cities. But if you talk about our core constituency, which is Middle India, I don't see a lot of space for non-domart right now.
Do you think culture plays a very big role in consumer brands or in D2C kind of brands? Like you said, in US there's a different culture, in India there's a different culture.
So see, consumer behavior is a complex subject because, and again, culture is uh, something which we carry around with us throughout the day, where we come from, and that determines the kind of choices we make, right? Um, when venture was very early in India, probably let's say in 2000s or even till 2012, 2013. There is something called X for Y model, which is we were picking up business models from US and other markets and replicating them in India. This is what is called the X for Y model, right? But post 2013-14, with micropayments, UPI, and India tech stack building the baseline, um, the behavior is very, very different in India, right? And founders are now looking for unique need of Indian consumers versus copying from US and bringing the B2C business model to India. So that way, yes, India is a unique country where you have a large part of the population is still earning very little, and also which will their disposable income is going to rise in next 15 20 years as we transition from $2,800 per capita to $10,000 per capita. um, so it's unique challenges in India, and even in India, you have rural areas within urban areas, and cities themselves are very complex, etc. The way they are built in India. So yes, culture plays a very, very important role when it comes to buying behavior and buying patterns. So you cannot copy the way you build a consumer brand in US and replicate that model in India, right? It's very complex. Um, and yeah, so that's something which founders should be mindful of. They can always take inspiration, but they will have to customize to the local market when it comes to their go to market and the pricing.
So let's move on to the next startup. So the next startup that we're going to talk about is into the EV business. So Kulmani, last month I think we had a podcast with Shashank, who was from Bolta. So can you share some learnings about the EV industry?
So our learnings are manifold in terms of when we think of EV, we are largely thinking of mobility and then the charging infra, right? Which is the front end part, let's say battery swapping or charging points. But if you dissect the different players or different layers within the EV ecosystem, I think there are still many opportunities which will probably unfold in the coming years, whether it comes to software, whether it comes to component level suppliers, etc., etc. Right? And with the new energy policy coming into force in the coming years, this is going to change, right? Currently, EV in India is largely shifting pollution from crowded areas to different areas which are not so crowded, because a large part of our power generation is dependent on fossil fuels, right? That is how the installed power generation capacity in India is structured, versus a country like France, where 80% it's nuclear, or Japan or other countries, where nuclear is definitely cleaner when in comparison to fossil fuels. But to build a nuclear plant takes decades, right? Power is one of the sectors which I used to cover early in my career, right? Power generation and infra. So that way, I think there's sort of a dissonance when we think about EV. EV is clean if the underlying power generation technology is also clean. Otherwise, you're just shifting the pollution from crowded cities to an area where the power generation is happening, whether that's coal generated or oil generated. It's always going to contribute to the pollution, right? Um, I think in future, what I expect, we have couple of podcasts coming up with VCs who are operating in EV space. But I see a specialization emerging in terms of their investment thesis with regards to different layers within the EV ecosystem. I think because the whole overall market will also mature in the coming years, and that's where we have distinct thesis emerging, right? So that we will learn in the coming episodes.
Thank you, Gulmanish. The startup that we're going to talk about now is called Vidyut Tech. So, what Vidyut Tech is trying to do is that they are evolving the EV ownership by making them more affordable. So, they have partnered up with 10 plus EV manufacturers, and they are enabling the customers to lead the battery usage instead of paying it upfront, which reduces the cost of the vehicle by approximately 35 to 40%. Through this, through the model of leasing out the battery usage, they have a pay per kilometer subscription model, which allows the user to pay for the battery that they have used on a monthly basis, making adoption of EV more accessible and cost efficient. So last week, in week 9, they raised about 2.5 million from Flourish Ventures, and in the last financial year, which is 2023 to 24, they generated a revenue of $265,000. And in comparison to the previous financial year, they saw a growth of 150% from a revenue of $105,000.
Yeah, I think if I look at the overall EV space in India, right, it's like very early right now if you compare it to US and other markets, because of charging infra availability, financing option, um, our domestic manufacturing capabilities, assembling capabilities are, I think, still evolving, right? So again, X for Y may not work at this point also. The way Tesla is selling cars, they may not be able to sell in India when they enter. Remains to be seen. Also, there are established players. But Vidyut may be interesting. So is it for personal vehicles or is it for commercial vehicles? It's for commercial vehicles, right?
So they are doing it both for commercial as well as personal vehicles.
Hmm. So I buy, let's say, an EV car, and I go to loan go for loan to Vidyut, or I go, how does it work?
So it is only for three-wheelers and two-wheelers. It is not for cars. So the major customers that they have are fleet owners, but there are also some individual drivers who are purchasing from them.
Yeah, so I think this is use case for then commercial vehicles more than personal vehicles. And I think this 18 to 20% may be offset by the resale platform which they are building, where customers can get up to 40% of the original price they paid for the vehicle. Okay. I don't know, it could work out, but this seems like more of a balance sheet business to me because this is about resale, financing. I don't know how much experience and they're partnering with NBFCs, etc., at the back end because obviously they don't have the NBFC license at this point, I'm assuming. I mean, in the sense, there are many risk factors to this kind of business. First, you need to have enough uh, spread to make money on this lending business. And second, if you're giving back 40% of the original price, then you also need to manage that risk because these vehicles will be sitting with you after you purchase them. So what do you do with them? Sell them forward? I don't know. Yeah, so when it comes to financing, I think they are going to be competing with these like uh, giants like Shriram and Cholamandalam and like banks also will start looking at this space. So it's not going to be a cakewalk for them. That's what I understand from this. But definitely, let's see how it works out. Currently, they are in they're in a nascent stage. I think their team is also very small, and they're not disclosing how much loans are they dispersing. But definitely, we can watch this and see how it works out. But definitely, it's like a balance sheet business. They are in the lending business, and then second is they are buying these used vehicles and guaranteeing some kind of baseline value, right? Again, I think it's complex. It has more to do with finance and less to do with technology at this point.
So these are the three startups that we have covered in the early stage.
Great. So I think this is it for the inaugural session for Weekly Digest with Fibonacci X. So we looked at a couple of interesting startups today, including B2B commerce, affordable cancer care. We looked at innovative EV financing model, public laundromats, and our whole ambition is to learn how these different business models are shaping up the whole startup ecosystem in India, right? And obviously, consumer side remains heavy for us. And this week, luckily, consumer retail and tech, there were about 7 out of 18 deals were in the consumer space. Um, and we plan to be back next week, and we want to do it every week, going forward, where we talk about insights into India's evolving startup landscape. So stay tuned and don't forget to follow Fibonacci X. And you can also visit our website. And looking forward to bringing the next edition of Weekly Insights to you. Thank you.